Good morning, traders. Excuse me. It's fairly early Saturday morning on the 10th of December. This is the custom index video that I produce. I'm trying a much better quality video today, so we'll see how this plays out. Hopefully, it should be cleaner and sharper on your side. We need to go over the basics of what's taking place in the market and understand that we're nearing the end of the year. We're only about 2.5 weeks away from the end of 2022, beginning of 2023. We are expecting the Fed to potentially raise rates before the end of this year. I do expect at least a 50 basis point rate increase. I think the Fed is consciously aware of not trying to break anything, but still battling inflationary trends. The economic data that came out this week is much softer than where we were about 6, 7 months ago. Inflation is declining. We're moving into kind of a stagflation type of an environment where consumers in the US are still rather strong. They still have capital, they're still working, employment numbers are fairly strong. But we're seeing some real caution, meaning that we could see something break. We could see something unusual in this low volume end of year move. Now, I still do expect 2023 to be fairly common or fairly solid. I expect earnings to be fairly solid. I expect employment to be fairly solid. I expect weaker real estate. I expect consumers to reengage. And that may happen really come February, March, April. Maybe not between now and the next 60, 90 days, but I do expect the U.S. markets to hold up. I expect the U.S. dollar to still hold above like 101, 102. My real numbers are that 103, 104, 105 level. I think the US dollar is going to stay strong for a while. I believe oil is going to decline. I believe even though China is going to open up, I believe the extended risk factor of COVID and basically human pathogens are going to stay fairly solid over the next couple of years until humanity builds immunity to it. I think we're going to have to be safe, and I think it's going to disrupt the economy in some way. For example, China is going to try to open back up, Europe's going to open back up, but we're in the middle of flu season, and we've got COVID variants, and we've got other things going on. I mean, the reality is that I expect things to be kind of touch and go with regards to locational viruses and illnesses coming up. I don't expect it to be massive like a global shutdown, but who knows? We could see something happen eventually. What I do know is that the world wants to continue to move forward. The world wants to continue to grow. And as I put out in my video a couple weeks ago, we have 180 million plus workers in the US that are earning and contributing to their retirement accounts and saving and investing and looking at what the next 10 or 15 or 20 years is going to be like. And that means that we have, and again, when you think about it worldwide, we have something like 6.5 billion people working and struggling and trying to save and invest and grow. We've had more people in the world right now than we've had in the past 100 plus years, thousands of plus years. And the real reality is that the bias in the market, barring any major collapse event or major crisis event, is going to be to the upside, in my opinion. So when you're listening to all these doom and gloomers and the fact that, everybody's believing the Fed's going to break something, understand that, the markets are vastly different than where they were in 2008 and what happened in 2008 or what happened in 2000, 2001. Remember, 1999, 2000, we had the dot-com bubble burst. This was a speculative phase that blew up, which was pretty much US centric. Okay, it didn't really grow into a massive overseas bubble. It was mostly US centric. Then we had the bombing of the World Trade Center, the terrorist attacks. That was, next year, September 11th, 2021, which was essentially an act of war and disrupted the global financial markets. That sent the market into a bit of a tailspin. It was US centric. It was U.S. technology firms deflating, and then a U.S. Attack on U.S. financial banking systems with the terrorist attack in New York. That was a major catalyst. And again, it was U.S. centric. It was something that, didn't happen in Europe, didn't happen in China, didn't happen in Asia. It happened in the U.S. And the U.S. at the time, being the strongest economy on the planet, reacted. And of course, the world reacted to it. 2008, 2009 global financial crisis was again a US banking and financial crisis. At that point in time, this was multiple trillions of dollars at risk related to excesses in place by the banking system and failure to actually control anything. The real reality, ladies and gentlemen, is where is that catalyst right now? What is going to cause the markets to collapse hypothetically? Do you think it's going to be the Fed raising interest rates? Well, go take a look at what happened in 82, 83, 84, 85. I mean, I was alive at that time and I remember it very clearly. You want to know what happened? People curtailed their spending unless they had excess income to be able to deal with the 14, 15, 16% interest rates. People still bought houses. People still rented houses. People still bought cars. People still ate. People still spent money. What happened was the Fed was dealing with an inflationary period. Yeah, I remember when gas was 60, 70 cents a gallon. I remember when gas broke $1 and waiting in lines during Jimmy Carter area. Remember the odd and the even days if you were out here in California in the late 70s and early 80s? You had to wait for your license plate, whether it was odd or even. You had certain days of the week you could go get gas, waiting in line. And I think gas at that point was like $1.03 or $1.10. But anyway, long and short of it, guys, we're dealing with something that has to be kept in perspective. So now let's get to the chart before I get sideways. Where we're looking at here, this is a daily chart, and I want you to see what's going on here. We've seen a very solid contraction. We are seeing a downward trend here with the Fed raising rates. I'm counting 1, 2, 3, 4, 5, and I'm seeing the waves 1, 3, and 5 equaling these totals. I've drawn them out for you: 703.97, 964.83, and then down to this price level here, this Fibonacci level, 736.75. So understand that wave 1 is 703.97, wave 2 is 1.382 times wave 1, and wave 5 is 0.75 times wave 3. So ideally, wave 3 is the biggest wave. Wave 5 is almost equal to wave 1. It is a great Fibonacci alignment. And as we go further, wave 2, the contraction wave, this wave right here, is 0.7399%, almost 0.75 of wave 1. So this is essentially a 75% retracement of wave 1. Wave 4 is a 0.6617% of wave 3. So here we have almost a perfect 618, a little over type 618 type of retracement. You can see also that wave 2 is a 1.382 extension of wave 1. Okay, we've highlighted that here. You can see that wave 5 is a 0.75% extension of wave 3. Well, you can see that right here with the Fibonacci level. Okay, wave 1, 2, 3 is 1139.41 points, which is a total of 1.618 of wave 1. Very solid Fibonacci alignment. Wave 3, 4, 5, which consists of this down wave here, this wave here, and this wave here, is a downward trend of 1.05645, which is a full 2.0x of wave 2, which is this wave here. It is a 1.41% of wave 5, which is here. Understand that that's very close to 1.382. And it is a 1.09% of wave 3, which is almost equal to wave 3. But you need to understand that this is from wave 3, 4, 5 is telling us that this is a little bit beyond this wave here by about 10%, 9%, which, believe it or not, is another Fibonacci number, 0.8, 0.0875 roughly. So understand that we've got a very solid Fibonacci alignment to this wave 5. And I believe this support level becomes critical. Now, price, as I'm telling you, always attempts to move to new highs or to new lows. So in theory, I want you to understand that price could come all the way down here and attempt to break into this area into new lows. Okay, so price could move downward and could attempt to break into new lows. I'm not saying that it won't happen. I'm saying that price could happen. Price has moved up above this high, and we're getting close to this standout high here on the SPY. It is very critical at this point, ladies and gentlemen, that we move above this high. Try to highlight it. Oh, let me come over here. I had it perfectly at 0 and then it moved. All right, close enough. Minus 3.04. That's almost a horizontal line. Price has to get above this level, which is 41.25, roughly 41.20 on the SPX. This is the $ SPX, S&P 500 index. It needs to continue to move above these highs. Right now, we're dancing around this channel, this resistance channel. We've pulled back down to the downside. It must attempt to move back above this recent high and then break above this 41.20 area. And once we get above this level, I'm going to tell you that based on Fibonacci theory, we are moving upward. And at this point, we are going to see an upward trend continue, some sort of a shifting. Now, from a broad scale basis, I want you to understand that we still need ultimately to move above, and I'm going to try to do this so you can see. We still need to move above these previous high points, this wave 4 point, this wave 2 point, and ultimately back above this wave A point. We need to, if markets are going to establish a new trend, so this could be, again, what I'm trying to show you is this could be a very big up wave like this, and then we could have a peak, and we could be moving down here to a down wave, which could come back up to here as a retracement wave, and then move back down into here, potentially as a downward wave. So we do have that potential that this could be an A, B, C, D, E wave 1, an A, B, C, or possibly A, B, C, D, E wave 2, failing to get above this level at A, and then rolling back to the downside. This could very well happen. We don't know yet. What we do know is that we are flagging into a sideways formation. We've got a Fibonacci aligned base here near 3571, and we are moving decidedly to the upside, trying to break this channel. We're at a very interesting time near the end of the year. We're probably just going to flag out sideways. We're probably going to see some solid rotation. I do believe that after the December 13th, we could see some more movement in stocks, but let me explain what happens right now. Very low volume, very low volatility. Traders do not want to hold over the weekend. Tax loss sales are kicking in. They've actually already, in most cases, taken place. So we've got, a lot of cash is sitting on the sidelines that's going to re-enter the market between January 3rd and January 15th, roughly. We've got Q4 earnings coming out near the end of January. I expect earnings to stay fairly solid. I expect, ladies and gentlemen, to see an upward movement back above this wave 4. So again, 43.20, 4,300. Get above 4,300 here. We need to see, I expect this to happen, get above 4,300, possibly up to 4,450, 4,500, stalling back out possibly near this wave 2 high, which would be a decent correction. in the market. This would essentially be a 75 to possibly 82% correction in the market, and then a stalling, and then potentially into early January a move back to the upside. Remember, my cycle pattern suggests that we're not going to see any major crisis event take place until 2027, 28, 29, or later. Okay, so I think we're moving back into a melt up phase. Are there still risks to the downside? Yes. I want you to be aware that when things change, if things change, I will change my direction and tell you that it's going down and we are breaking to the downside. Right now, I'm seeing enough strength that I believe we're moving back to the upside. I think we've averted a Fed move. I think this is a post-COVID speculative move with inflation. I think it's going to settle back down, possibly into normalized inflation, say roughly 3 to 4.5, maybe 5%. Over the next year, and the Fed's going to be able to weaken a little bit, moving us into a fairly soft landing. Okay, so let's go over to the custom indexes. Cash flow index has shown that traders have really jumped back in here near the end of the year 2022. We're back just below the COVID highs back over here. You can see that we've stalled out. We've pulled back downward a bit. We probably are going to flatten out. We may see a little bit of a melt up trend moving into the end of the year and beginning of 2023, but we're probably going to stay fairly flat. Remember, low volume, low volatility. This is the end of the year. We only got about 2 weeks to go before we're going to be in 2023, and things will pick back up after January 10th or 15th. So we might see this just kind of flag out, go nowhere, kind of like what happened back over here. Flag out, go nowhere near the end of the year, and then start to pick up. And you can see it kind of does that near the end of years. So here's the end of the year 2020. Here's the end of the year right here, 2021. Here's the end of the year 2018. You can see 2018 was a big sell-off. This was a Fed-driven sell-off in the markets. So could we see something else like this? Yeah, we could see something breaking to the downside. We could see it retrace back down here to 1.2, maybe 1.25. That could happen, ladies and gentlemen. What I think is going to happen is next couple of weeks, it's going to stay fairly flat. I don't see any major impetus right now. The expected Fed rate increase in December is already fairly well baked into the market. And remember, so if you were to, again, follow these trend channels, we had the excess peak up here at around 190. We came all the way back down here to 1.02 roughly. So this is a halving almost of the data, okay, of the cash flow activity. This tells you that we've seen essentially a 50% collapse in the market over this time frame. Now we've seen from this level about a 39%, 40% increase in the cash flow activity, meaning cash is moving back into the market. What are we likely to get back up into this level and see another speculative phase? Maybe in 2 or 3 years, not right now. Are we likely to get back above this COVID high level and maybe stall out around this 1.55, 1.65 level? Yeah, that's very doable, especially if we avert any crisis mode, okay? So now let's go on to the next chart, which is the consumer engagement index. Consumers are still rather flat. We're down here near these lows, 0.15. You can see these were the lows back in June. This is a monthly chart. This is telling us the consumers are still pulling away. They're not engaging with the economy. They're not coming out and spending, although I do expect the end of the year to kind of just stay flat, possibly stay up in this area, maybe a double bottoming, maybe an upward trending phase here. We're not seeing consumers re-engage. And this is very simply put that they are unaware of what the Fed is going to do and how they're going to move forward with this. So the real reality, ladies and gentlemen, is that we need to stay cautious of this move near the end of the year, and we'll look at what is likely to happen in January, February with earnings, which I think will be moderately strong again, and that may move us back into a nice upward phase. So we're basically going to flatten out and stay fairly sideways. Okay, next we have the large cap index. Large cap index is flattening out again. You can see November was very weak. with a doji down off of these lows. And again, you can see here we've come from these highs, roughly 1.18 roughly down to 1.39. This is a pretty good move. This is an 18-20% downside move in the large cap index. And you can see historically we've seen similar types of move. This is about a 20% downside move. This is about a 25% downside move, maybe a little more. You've got from here, you got maybe about a 25% downside move. And these are typically the end of these types of corrections. So historically going back, large cap index would contract about 20-25% and then find some support, kind of base, and then start to move forward. Now, it can take many months to form support, like we saw here, back over in this area. So we could see some real extended support out into 2023, maybe April, May, June, before large caps start to move higher. But I don't see any big downside risk right now. The move is pretty much exhausted and stalling. And unless, like I said, some catalyst takes place, I don't see a big downside risk right now. It's obviously maybe a 10 or 15 or 20% downside risk, but we're not seeing any collapse. So next we have the global asset index. Global asset index broke below my box. I talked about this a couple months ago. I was looking at this to try to be support. We're now down in the 70 range and we had been up in this 59 range. So you do the math real quick. That's about a 20 to 25% decrease in global assets on a monthly basis. Again, we haven't seen anything that deep since back here in 2013. We again could come down further. We are not extending downward in December. We're not extending upward. We've got a very tight flat bar. You can take a look at the end of the years, normally December here. This is December 2020, or 2019, which was prior to COVID. This was end of year COVID right here, 2020. End of year 2021, we had this peaking. Most of the end of the year is fairly flat. So you can see here and back over here, we see a nice little solid downturn. But long and short of it, end of year bars, December bars are really fairly flat. And that's because, here's another example, this little doji, because there's just not a lot of volume. So I would expect this to flatten out around 70, above these previous lows, possibly getting back up above these previous highs, back maybe 67, 68. But like I said, we won't really know until early 2023 what the likelihood of the trend is. Until then, it's going to probably stay flat, stay sideways, and maybe melt up a bit. The gold custom index monthly chart is showing more accumulation, which is great. Holding up above this lower green level is fantastic. We want to see this accumulation take place while gold is moving higher. That's ideally what we're looking for. Then eventually, as I mentioned, we'll get into the big speculative phase, which may come in 2025 or 4, 5, 6, 7. But it's going to happen, in my opinion. You can see this has happened repetitively, these big hooks. 2011 and 12, we didn't see, we saw a big move, big speculative phase move here. Then we saw a big speculative phase move here, then it flattened out. But we've had a couple of big moves over the last couple of years where we've seen this accumulation take place near these lows and then a big speculative blow. Accumulation phase, this is really a big rally phase where accumulation traders are piling into a big uptrend, and then they move out of it. And this is, let's call it distribution. So now we're in the accumulation phase again, which is great, because if we get another move up into this area, or even up into this 60, 65, 70 area, this is going to be a big move in gold, well above 4,500, 5,500 in my opinion, possibly above 7,500, 8,500. Okay, next we have the market timing index. And a market timing index is still showing moderate low fear. Remember, above 7.1, 7.2 is a little bit higher. That'd be below this green line. And then we need to be concerned about this 10.35 level, 10.25 level as more extreme fear, and then this is the red level at 14.92 or 15 roughly is extreme fear. We're at a point here where fear is very weak. We don't have a lot of fear. We are in an uptrend on the S&P 500. We are in an uptrend here with our cash flow index and our market timing index. Sorry, this is the market timing index. We need to see how this plays out, ladies and gentlemen. We are near this middle area from the COVID move. So you can see here this 0.50 area here and the 0.50 area here. We're kind of right in the middle of that. We do need to move higher. I do not expect it to come back up and reach these extreme peak levels. These were speculative extremes, okay? I do not expect this to rally right back up to these extreme levels and continue to move higher. But I do expect the S&P 500 over the next 24 plus months to continue to appreciate. That's what the capital that the global central banks and the Fed have provided into the system. That's naturally what happens to the capital. Capital gets put to work in the economy to generate profits, to generate returns, to attempt to find solid ROI, and that ROI over time, as well as increased workforce, increased contributions, increased expectations of asset values and profits, continue to see the market move higher over time. This timing index may move back up into this 1.75, 1.8 area, kind of up into this upper area where I've drawn the green line, and then roll back over. I don't expect it to get up into this 2 area or 2.25 area unless we get into another speculative peak, which may happen in 2025, 6, 7, 8. That might be a good peaking area, but we're in more of a melt up phase right now. So expect this to break this channel, move upwards, stall, move upwards, stall, move upwards, stall, while the S&P 500 continues to advance, okay? Next, the tech ratio index stalling out in December, very solid bottom. You remember last couple of weeks I mentioned you could start taking small token positions potentially in technology if you really wanted to. I call these anchor positions. Technology is very weak right now, and I expect Q1 and Q2, well actually Q4 and Q1 and Q2, so that means Q4 2022, Q1, Q2 of 2023, to still be rather surprising. Yes, you're going to have user contraction. Yes, you're going to have a rebalancing of expectations going forward. But I'm telling you, I still believe that Amazon and Microsoft and Google and others are going to continue to show fairly strong earnings through the next 2 or 3 years, especially as we move into a new, let's call it momentum base going into 2023 and 2024 for forward growth. So I do expect technology not to maybe reach these peak levels in the next 12 to 24 months, but certainly to be back over here in the 45 to 50 area, maybe 55 area over the next 2 or 3 years. I believe it's going to be very likely that we are going to move into a sideways upward trend after all of this revaluation stabilizes, and technology could literally double from where we're at right now, moving higher. Now that includes, you know, some of the ARK funds and some of the undervalued innovation funds as well. So be aware that we could have a very solid move of extreme devalued stocks right now. The US to global market index. The global market index moved a bit higher. Remember, the global market index had collapsed almost 70% over the last couple, about a year, and a little over a year, and is actually recovering quite strongly. The U.S. markets have stalled back out here. This is because of U.S. markets really didn't have that kind of a collapse to begin with. We're holding up above the pre-COVID levels. We need to get above this channel, this downward channel that's taking place, but the strength in the global markets right now is looking pretty good. Remember, we need to see this move in unison. So pay attention to growth phases. So 2017, we had the US market and the global market, the US being the blue, global being the red, moving higher. And then we had in 2018 a declining phase in the US for a while. Then both US and global market, then US moved a little higher right here, then they both decline. When they move in unison, you get a pretty good indication of what's coming. So once the bottom in 2018 took place, you can see in 2019 the US and global markets started to accelerate a bit more. Then global markets here kind of topped out, rolled sideways, stopped accumulating for the most part to the upside while the US market did. Then COVID hit. Both of them moved in unison to the downside. Both of them bottomed. Both of them moved in unison to the upside up until roughly middle February, March, April of 2021. At that point, the global index started to roll downward. The US stock markets continued to move higher. This is where I see the divergence between the US and the rest of the world. The US continued to move higher until we had a peak. The rest of the world was already saying, look, we can't do what the US is doing. So there's money moving into the US markets here and moving away from global market risk. Right now, money is moving into global market assets and moving into the US market, but it's moving a bit more aggressively into global market assets compared to the US market. Yet the US market is still much higher in asset valuations. If we see this move back to the upside in early 2023 or through the end of this year, we have a pretty solid unison move. So understand that none of these moves to the upside were correlated really to moves in global markets. So you see this little move to the upside was weak here. This little move to the upside in the US market was very weak here, almost non-existent. This little move to the upside is actually showing some pretty solid strength right now. And we've broken through trends at this point. If this were to continue to move higher, the US market, if it's going to follow through and not fall apart, is going to continue to move higher as well. Maybe back up into this 90, 95, 100 area. So understand, we've got some real solid potential for a melt up here. And all you got to do is watch for these to move in unison to know that the engine, the economic engine, is firing on all cylinders. If it's moving up like this in unison, it's firing very well. If it's moving up like this in unison, then we're going to see some global asset price appreciation. If it starts to diverge or move downward together, then we have a broader risk. Both the US and the global markets are moving downward. And that's really where we get into recession, depression, or worse, crash. US valuation trend index is, again, not finding any real support yet in December. This is very important to understand that we may not find any support. We may not see any real support. We may just flatten out the rest of the December, looking for some kind of an impulse move in Q4 earnings and early 2023. But we are still holding above this historical support level from 2013. So we need to see it kind of hold here and attempt to move higher. If it does move higher, it's going to be into this this would be 1.6, 1.5 area where I'm pointing, and that's going to be essentially a 30 to 40% upside reversion in the U.S. stock market, and possibly a 50 to 100% upside move in certain technology sectors. Okay, the custom leading index weekly chart. I highlighted this in another chart here. You can see we've broken this channel. We're weaker. We're in the upward trending. This has actually historically been very solid upward trending. 2018, 2019, 2020. This has been moderately strong upward trending. So if we stay in this upper band over here over the next couple of weeks, this is actually staying very positive. We could see some downward move. We could see it retest the 180 area, which means we could see it slide sideways for the next 5, 6, 7, 8 weeks, maybe a bit longer. But we're moving back into very solid bullish territory after this deep, deep low. This was a very solid low. You can tell these lows here in the past, back down into standard deviation middle area, back in this area here, and exactly where this low hit right here is pretty solid bottom. So now we would obviously, in order to re-enter a downtrend, we would have to see some sort of a catalyst to bring us back down. So understand that we need some kind of a cat. We've already seen this extreme low. We've already seen this extreme pessimism. We're starting to hook back up to the upside. So think about a crash. What would be the catalyst? Housing, possibly, maybe. War, maybe, possibly. Financial system collapse, maybe, possibly. Bitcoin crypto collapse, maybe. I consider that fairly small on the global scale, and it could be very isolated. But compared to the world economy, crypto is maybe 2 trillion right now, whereas the global economy is a little over 100 trillion. So crypto would be mild. Anyway, where's the catalyst? I just don't see the catalyst yet. The biggest catalyst in my mind is a major virus or pandemic again, or some sort of a major financial collapse. Okay. I don't know, war with Russia, war with China, something like that, a financial system collapse, which could, disrupt maybe 20, 30, 40 trillion in assets or commodity supplies. Custom volume ratio index is weakening into Christmas. Pretty common. I mean, look over here. This is Christmas 2020. This is again Christmas 2021. Here's Christmas 2018. Now, what was this spike about? Okay, well, this was the bottom on Christmas Day, a very big bottom that took place. We had a lot of accumulation at that point because of the deep, deep lows, and people were buying the deep, deep lows. Could it happen again over here with deep, deep lows? Yeah, you betcha. Okay, if we see some sort of a Fed shift or a move up above the resistance channels that I've been showing you on this charts, we could see a December 23rd, 24th, 25th, maybe, well, the 25th will be closed, but we could see a big, big spike just like we had back here in 2018. And remember, 2018 was right here. Why was this such a huge accumulation in the stock market? Because we'd seen stocks move from the 1.85, 1.88 area down to 1.4 area. We'd seen a 35% collapse, and then the market just bottomed. People determined that that was it. I want in, I'm buying the dip. And the Fed had already weakened on their stance for interest rates, and everything moved back up. We had a very solid reversion. This is about an 80% reversion right here. We've already seen this buying take place here, but could we get a reversion trade here on some kind of a big move upward? You betcha we could. Could be a nice December surprise if we really wanted it or went for it. Okay, commodity gold index flattening out. We're seeing gold move higher. We're seeing commodities weaken. Big news is lumber is getting weaker and weaker and weaker, which people are saying is, very foretelling for the real estate market. I think the real estate market's got at least another 20, 25% decrease in prices in certain areas. But I think it's going to be very different than the 2008-9 global financial crisis. I think it's going to be isolated, more moderate meltdown than a complete collapse. I think we could be looking at fairly high interest rates for the next 3 years plus. I think we could be looking at a meltdown in asset prices, particularly if there's a disruption in labor or other concerns regarding inflation. But I think everything's going to flatten back out. I think we're going to start to see some accumulation, maybe late 2023, 2024. But in the meantime, this is just going to flatten and stay moderately elevated in a very tight consolidated area as long as the Fed keeps Fed fund rates above 2.5%, 3%. Next, the commodities custom metals trend index moving higher. Metals are really moving into kind of a breakout phase. This has been, silver's up, gold's up, platinum's moving higher. This is really a very solid bottom. I had been calling it back over here. I had been trying to warn of the support level back over here. And these custom index charts work wonders, literally, in helping you see what's going on. As a matter of fact, I ordered a little extra gold and silver last week because I wanted to rebuild my stack a bit. When I say rebuild, I'm saying it funny. I already have a pretty decent stack. I wanted to extend it. But long and short of it, ladies and gentlemen, starting to move higher, and the next move is going to be back up here to these all-time highs. It may take until May, June, July of next year, but gold is and silver are starting to accumulate as fear starts to elevate. And I think the real fear here is what's going on with the global markets, not necessarily the U.S. markets. I think the real fear is what's happening with at-risk countries throughout the world, and the U.S. is fairly stable, which again is kind of where we were in 2002, 3, 4. The U.S. was fairly stable. What was going on with the world at that time was wars and uncertainty, particularly Afghanistan and Iraq and those areas. So I think we're kind of in the same scenario. We got wars in Ukraine. We got unknowns going on in uh, China. And we're seeing here, U.S. is fairly stable. Gold is just going to start accumulating as a hedge instrument. Next, we have the FANGs index. FANGs are basing and bottoming, like I told you, staying down here near this lower middle standard deviation channel. You do, again, ladies and gentlemen, you do have the potential for a little bit more weakness, possibly about I'm going to do the math real quick in my head, 7 to 10% downside move potential to retest these lows around 120. But this is a very solid basing and bottoming formation. I still like the idea of picking some technology companies on small anchor or token positions. When I say that, I'm talking about, maybe 1 or 1.5 or 2% equity allocation, something very small. But you could move into a very small token position as we're basing in this area, expecting another rally phase. Now, a rally phase from this level is going to put us up into this 160 level. So that's going to be about a 45, maybe 55% increase from technology here. Some technology companies could more than double. But, I don't expect Google to double. I don't expect Tesla to double. But Tesla could. Just understand that you've got a very good opportunity, especially if we get some sort of a little 5, 6, 7% pullback. Next, we have the custom metals index chart. You can see we're attempting to break out again. We have gotten above this previous high right here. We need to see some good solid consolidation back to the upside, meaning a good solid breakout. We didn't get that last week. We are in an uptrend. RSI is moving higher. Stochastics is moving higher. Once we get above this 410 roughly level, this previous high right here, the next target is up in this area, which, are doing the math real quick, could put us about 427, 428. And once we can get above this level, then we're off to the races. But pay attention. This is really starting to accumulate here. We're just not seeing the big accumulation in price yet. Silver's moving higher. Gold hasn't really done it. But remember, back over here, the gold trend, the metals trend index, is already well above these levels. So if you look at this peak here, this is the peak that I'm pointing to back over here, right here. And we've already above that here, and we're above that on the trends index. Now we need to see this move up to this level, which again, from 410 to 427, I'm trying to do the math real quick, 41. So that'd be about a 6.5, 7% rally phase, looking at metals possibly before the end of the year. Smart cash index, this is the global smart cash index, is moving higher. We're running into resistance here near this gap. I talked about it last week. We will likely see this continue to move up to this upper level, 455 roughly, before we stall out. That's going to have filled this gap. So up in this area where these bars are, right across this area, let's call this 456, 457, probably some resistance. But ideally, this deep low and this recovery, unless there's something to disrupt it, is going to continue to move higher. Next, the U.S. stock market index. This is the consolidated custom U.S. stock market index. You can see we flagged back out here. I've shown you this chart again. I've highlighted the pattern that's setting up. I've highlighted the fact that we could see some sort of a sideways rotation back here. Maybe setting up till December 22nd. Remember, that's the last trading day, 22nd, 23rd, just before Christmas. Christmas on Sunday, the 25th. And then we get into the last trading week of the year. So we really have another week or two of maybe sideways downward activity, possibly, maybe a sideways flat activity. But I do believe there's a very strong chance, 60, 70% chance that the markets are going to try to move higher into the end of the year and into early 2023. And that would mean that from this standpoint, we would expect this support level around this light blue line to hold up. And we would expect some consolidation into this end of 2022 mode before we get some sort of a breakout in late 2022, early 2023. And you can see we are already below the standard channel here. We've gotten very low down here at COVID. We got very low recently here. I don't believe we're going to see these lows again. I think we're going to form kind of an inverted head and shoulders where this would be the left shoulder, this would be the right shoulder, and then back over here we'd have, or sorry, this would be the head and this would be the right shoulder. That would put our neckline hypothetically right around this area, possibly down in this area here, but I would call this the shoulder level here. So that means 1100 roughly is our level. We need to see 1100 taken out and rallied above, and we are in a bullish trend. Next, the custom valuation index, again, just like the commodity to gold index, is flat, moving sideways. I really don't expect this to do much over the next 12 to 24 months. Maybe back up into this 64, 65, 70 area here. But this was a massive speculative phase. I don't expect us to get anywhere close to these big numbers, 120, 140, 160 or higher. I see us staying in this roughly, call it 52, 55 area to 65, 75 area, and moving within these channels until 2026, 27, 28. Then we might see a speculative move back up into 120, 160. So this is really basing bottoming and revaluation. The lovely volatility index, boy, did I call this. Remember last week I told us that we'd move back up into this upper channel. We're either going to break out or we're going to stall. And I likely thought that we could see a stall back downward. We are still in bullish trending. This 9.0 is still moderately bullish. We are stalling back out. We're nearing these blue, what are called impulse channels or inflection points. We're likely going to stall back into this maybe 8 or 7.7, 7.8 area to 9.2 area, maybe back into this area before Christmas, stalling out, weakening slightly before we start to possibly get some sort of a breakout to the upside move. This is actually quite bullish, ladies and gentlemen. When you look at this, we have a big A move across here, B move down to here, C move up to here, D move down to here, and now an E move 5. So again, 1, 2, 3, 4, 5. This is a little false breakout, stalling back out, consolidation before Christmas, and then another rally attempt over here, I believe is very likely. Okay, I think this is it, ladies and gentlemen. Yeah, that's it for the custom index. So now what we're going to do is we're going to go on to the momentum, the rotational modeling index and the TT scanners setup. Now I want you to understand some big changes are coming in 2023. I'm going to start announcing some new services and features. I want you to be aware of what I'm providing for you. Go to MENT.com and check it out. Follow me on Twitter. Follow me on YouTube. I am getting ready to put together some intraday solutions for S&P, ES, and NASDAQ traders, NQ. Long and short of it, all of this has worked out perfectly. I mean, if you've followed me for the last 3 or 4 weeks, you know that my analysis and my triggers have been rock solid. And my trading systems have been rock solid. My rotational modeling system is almost at new all-time highs again. And now we just need to see how this plays out for the next 3 or 4 weeks. So come January, mid to end of January, I expect to provide more value, more service, and restructure things a little bit. And I hope you're enjoying. I hope you're following along. And I hope you really know and understand the value of what I'm providing you. Very few people can do this on a regular basis, and my custom index charts are part of the key to what I do. Remember, the rotational modeling system is a key component. The custom index charts provide context as to what the markets and commodities are doing. Then we move to the TT scanner hot list for ETF and sector trend setups on a weekly swing trading basis. And then if you still want more, you can go down to my live trades, daily swing trades setup, because that's where you can get not intraday, but daily 2, 3, 4, 5+ day trade setups. And soon in 2023, we're going to have the potential for intraday setups for the ES, the NQ, and gold. Okay, guys, more soon. Talk to you later.